Today, folks, the Dividend stock portfolio is now down a whopping $10,000. It should be down a lot more, but as a Canadian, I get some perks. I'm going to explain to you what those are in a minute and some of the moves I've done in this portfolio. But first and foremost, the S&P 500 is down 5.5% from this year's high. And like clockwork, when the S&P starts to fall off, the US dollar starts to rally. We can see as the market rallied coming into the beginning of the year, the US dollar fell off, but now we're getting this wicked rally in the dollar, which kind of counterintuitively benefits my portfolio. Being a Canadian investor buying US stocks, when those US stocks drop in value but the US dollar goes up, it cushions some of the conversion blow, because if I sold these stocks while they're down, I could still convert the US dollar to a higher value in Canadian dollars. Not that I'm doing that, I always keep my currencies separated, but it's one of these little benefits you might get being a foreign investor here in Canada, and that only works in this environment. That could change at any point in time. But what is driving this? Of course, inflation data. Let's talk about the inflation data. Let's talk about what I think is going to continue to outperform this year. And then let's talk about what I've done with my portfolio. I've done some really mild movements, correcting some stuff that I said that I would be doing. But first and foremost, the Fed's go-to inflation gauge, the core PC index, which basically stripes out the often volatile food and energy categories, showed prices rising about 0.6% on a monthly basis and 4.7% for the 12-month ending in January. And taking a look, I might have been wrong, not to a full extent, but I thought inflation was dead, and it looks like it's not dead, but it's a lot lower than where it was. Because if we take the last 6 months of data, I think this brings inflation to around 2%, meaning on an annual basis it's actually at 4% if we keep seeing numbers like this moving forward, which is way too high above the Fed's target of around 2%, which means the likelihood of them increasing rates sometime in the near term is very likely, which could be highly detrimental to the already stressed market, whether it's the real estate market, people with debt. We're already seeing savings rates falling off, people having to deal with these higher prices. It's a little different in Canada, however, because the Canadian core inflation rate here isn't nothing comparable to the US. I mean, we're well below the 2% targeted rate if that's what Canada is trying to go for. So Canada seems to be a little bit more cushioned in the inflationary environment, but we're feeling the pressure. This is something our families talked about a lot. I mean, think about it. Just because inflation comes down doesn't mean we're still not stuck in this higher priced environment. In order for us to get out of a higher priced environment, we have to see more negative inflation rates. We need to see people lowering prices of products and goods. What could happen is if inflation goes to 2%, but we don't see negative inflation, it just means we're now living in a world of higher prices. And that's not necessarily fun, but it's a really mixed, messed up bag right now. Let's be real. But let's talk about the investment side of this, because year to date, the S&P 500 ETF VOO currently up 3.44%, and again, falling off from the highs, falling in line with obviously the performance of the S&P 500. But on the 1 year basis, we kind of peaked here, in 2021, so a year and a half ago at, what was that, at $436 for VOO, which is down 16.93%. Let's take a look at the Qs representing the NASDAQ. This is actually doing pretty well this year, up 9.7%, but on the 1 year basis, we are a long ways from the all-time high here. From the recent peaks, we're down 28% still. So I made a bet kind of coming into the beginning of 2022 here that dividends would probably be proven resilient yet again. Dividend investors running around super excited, and that's where I put a lot of my money, was into the dividend ETFs, and I'm going to continue to say that's where the money's going to be if you're not looking at guaranteed investment certificates or bonds where you don't have to worry about this volatility. So let's take a look at some of these bets that I made with things like VDY. VDY year to date isn't performing, well, it's outperforming the S&P 500, not as good as the Qs, but taking a look, it's still up 4%. We're not talking about the dividends here either, so that's the bonus that's going to keep giving you the good returns. But when we take a look at the peak of VDY when I started making these shifts, it's only down 9.93%. So it's basically doubling the performance of the S&P 500, which is down 16%, right? So the dividend ETFs, again, you clap on the fact VDY pays 4%, and you're doing exceptionally well in comparison. The Schwab US Dividend Equity ETF, something that I heavily went into and kind of decided was going to be my core US dividend stock, is down 1.23% year to date, definitely on the year underperforming the S&P, but we're talking about stability and performance, because from the peak of SCHD, we're only down 8.81%, again, well outpacing the S&P, especially over that year if you tap on the 3.5% yield. VYM, another great US dividend ETF. This one's only down 1.22% year to date, and again showing pretty resilient from the peaks, because from the top here to where we sit today is only down 6 5.65%. These are things that obviously you need to take into consideration depending on how you want to see your portfolio moving forward. For me, I want to outperform the markets, and I still think putting money into these dividend ETFs is going to be a very good place of solidarity, at least for the next probably 6 to 12 months. People think the latter half of 2023 is going to be a lot better than what we're seeing now. But honestly, if inflation stays the way it is, if the Fed is going to have to continue to hike rates, we're clearly not out of this yet. So collecting that income and having probably GICs and stuff, which I haven't bought yet, but it's something on the roster for me, could be a good consideration. So what am I doing within my portfolio at this current moment? But firstly, a selfless plug. If you want to track your portfolio the same way I do, go to portfoliospreadsheet.com. These are my personally built portfolio trackers for iCloud numbers, Google Sheets, and Excel. You buy one, you get one for every platform. The personal finance sheets are sold separately, but what a great way to get a good overview as a Canadian or US investor. Well, as I said, I did do some selling. People are probably going to give me some criticism for this. I sold the S&P 500 slightly. I took a little bit of profit off at the beginning of the week to double up on SCHD. I've got about 90,000 Canadian dollars in SCHD, and I want to balance it out, so I have about 100,000 in there. I'm just waiting for my RRSP contribution from tax season. We're just going to get through taxes in March. I'm continuing to stack cash, and if the market takes a heavy pullback, that's when I would take more advantage of buying into things like the S&P. But I want to see a really big pullback. But for now, taking a little bit of profit out of there, doubling up onto the SCHD. I sold a little bit of TSM a couple days ago. Nothing crazy. I literally pulled like a couple grand out of it. Nothing that significant. Just to do a little bit of balancing, taking into consideration my fiance's portfolio. Again, stuff that I'm not going to show, but taking all that into consideration, I figured I'd just scale it down by like a percentage point. I'm not going to sell any more of it. Obviously, I really want to keep it long term. I think there's huge potential here. It's just going to have some volatility with the market. But again, great dividend payer. Nothing I have to worry too much about. But what I'd like to see happen here is basically as we kind of come through tax season, if the markets continue to pull back, which would be great, even if it's these dividend ETFs pulling back, because I want to get VDY to about 40% of the portfolio in this short term here. And I want to get my VOO and SCHD. It'd be nice to balance them around 40 to 45% because right now it's a little high. So I'm likely to pull a little bit of VOO out of my corporate account to pivot it into VDY just to get the dividend income up a wee bit higher. These are slight movements. They're so insignificant to the broad movements of the market, but new money is what I'm primarily focused on investing because the money that I moved was maybe like 10,000 at most between these stocks, most of it from the S&P 500. So ideally here, most of my new money, as mentioned, it will be focused on the Canadian markets because I think there's going to be more resiliency, presuming the inflation rates kind of stay a little cooled off. It's likely that if inflation stays down, I don't think the Canadian market will hike them as aggressively as the US might be forced to, because everybody's on a pause right now. Like the Canadian Treasury, the US, Jerome Powell, let's just see what happens. But obviously what we're seeing happening isn't what we want to see. So if those February inflation numbers come in too hot, we're going to have some issues on the horizon here. And it's annoying how volatile the market has been and how much things are changing so much, because like every opinion I have is constantly changing. So it's annoying how much you have to be updated on this market if you're trying to play the trends. And I'm hoping most people aren't. I'm hoping most people are just cost averaging, thinking about the 20-year long term here, because that's the only thing you can do. Because if you're doing what I'm doing, sitting here analyzing this month over month, you kind of can't be cocky about it. You can't just say, hey, I believe inflation is dead and I'm going to make these bets moving forward, because then inflation changes and you're like, shit, well, I was wrong. I mean, that seems to be the continual nature of this market for every investor right now. But I'll pass the question off to you. I'd love to know what you guys think about this in that comment section below.